Mitt Goblish at Comstock Investments. It's cold outside today, so I'm wearing a wintry type pullover, but I also have my Oxford Comstock button down on because today we're having an open house at the Royal headquarters, Royal Iowa headquarters, but it's awfully windy. So I'm going to talk a little bit about the supply and demand report, the USDA fundamentals report that came out yesterday. What I'll do for those of you that I've been through one of these previously on is I'll go to some charts. We'll walk through the charts, and then I'll come back and say goodbye to you at the end. So what we're going to do is we'll go to the charts, and I'm just going to go through them slowly. I've got some points on each one, and I think it's a nice flow to kind of summarize the reports yesterday, and hopefully those points will be well taken by the audience. So without further ado, let's go to that. Okay. Well, okay, we're going to talk about supply and demand, and I don't mean that as a funny guy because that's what the title slide said is supply and demand, but I want to make sure that we understand that we're already 25% of the way through our marketing year, our USDA and government marketing year for grains, and the supply and demand part of this is starting to really take hold, and we're starting to see some very critical aspects that we're going to walk through and see about today. I do want to mention up front that the orientation of the presentation is going to be on the agri-grain balance sheet. And by that, I don't mean a financial balance sheet. I mean a physical asset balance sheet. So you all know what those are. And in all that, the result of the orientation of these physical balance sheets right now in the United States is very oriented towards the supply side. And you'll see as we walk through the presentation what the dynamics and the importance of that is. So I just want to briefly want you to read the screen with me, and that is a lower supply or a lessening supply obviously comes fundamentally from two opportunities. One is the supply goes down, or the other, the demand goes up, reducing the supply side, or you can have a combination of both. And I don't mean that to be oversimplistic. However, in yesterday's USDA reports on the supply and demand, conservatively, they followed this pattern to a T. We had a little bit of a pullout of the corn carryover for next year, very slight, but that came through a demand increase on ethanol. Likewise, soybean, or not likewise, but soybean, the carryover came up slightly as a result of a reduction in exports. So we saw a little bit of a reversal there. And likewise, wheat had a bit of a higher carryover as a result of a lower demand, i.e. the export. So you see what we're trying to establish there as a trend line, so we can maybe make a pretty fundamental sense out of what happened out of the reports yesterday. The balance sheet sensitivity, a physical balance sheet sensitivity, is supply sensitive and supply oriented in corn and wheat. You already know that. And it's demand oriented on the oilseed side, specifically beans. That's sensitivity number one. And that's portfolio in futures and physical entity sensitive, okay? Secondly, on the sensitivity side, on the supply side, that corn is oriented towards end game stocks, which right now look to be heavy in critical domestic consumption, be it ethanol and domestic feed demand. And on the demand sensitive balance sheets and assets, we're more oriented toward global competition sensitivity, end stocks that don't look so aggressive and heavy, and a global consumption orientation, okay? So where are we? Where are the challenges now? We have a continued challenge. You look at the USDA previous forecast for end game stocks of U.S. grains, and that was last month's report. We had some analysis in between, and then we had an end game. So we're still very concerned about a big, bulbous, cumbersome, heavy carryover in corn, which is now based at almost 2.5 billion. Consequently, soybeans came off or came up to 2 million, and wheat also came up via the demand side decreasing on exports. So that's just kind of a flow through of what we mentioned earlier in that slide. Now let's take a quick look at the balance sheets, and this is what I mean by a balance sheet. It's not a financial balance sheet where we're equating assets and liabilities. In this case, we're saying here's our supply, here's our demand, and here's our beginning and inventories on both sides of that. And as I mentioned, corn was a little bit uneventful on yesterday's USDA report because it basically put another 50 million bushels of demand in domestic domestic demand, and hence it took 50 million out of the end stocks, and you can see where it was. And the concerning opportunity there is ethanol demand going to be remain sustainable, and is domestic demand going to be able, the two big pieces of domestic demand, be able to eat and erode away on those heavy cumbersome end stocks. Okay, so that's the corn balance sheet. And the bean balance sheet, keep in mind, beans are demand oriented towards sensitivity. We took away 25 million bushels of export potential, and we put that back into an end stock. Okay, along with a seed had a bit of impact on that as well. Now, I think that the single most important thing to take away from this slide is, number one, exports were strong last year, strong because of the weather issues and the weather premiums being built out of South America, which gave us an opportunity to build and segment on incremental growth, true incremental growth. And then the USDA raised those export numbers from last year, last report, okay, which it was a gutsy move. It was a gutsy move indeed. And now they're taking it back off a little bit. And I'm going to walk you through in a couple slides in front of us why I think that might be very important and critical. So keep that in mind. Put that in the back of mind as we go through. Wheat balance sheet, bit uneventful, adding 25 million to end stocks, which are already strong and already sensitive, simply by taking away exports. There's going to be a lot of global demand from wheat out of Central Asia, Europe, and the old Russian, the old Soviet Union stans, which are going to provide critical and intense competition to the major wheat consumers through North Africa and the Middle East. So that's where we are on the three balance sheets. Let's quickly talk about global inputs, because I did mention to you specifically up front that global inputs are incredibly important to demand-oriented and demand-driven balance sheets, and specifically beans, okay? So what I want you to walk away from on this chart is two things. One is take a look at the Chinese soybean exports, because we need those, must have those to reinforce where our balance sheet is right now on beans, and that is despite a little bit of drawback on the exports from the USDA. The other side of the business is the world end stocks, okay? And that's going to be critical in corn as well as beans, but more critical in corn. So that's what you need to look at. The top side of that graph and that matrix is simply, where's the competition coming from and so forth and so on. So as you look at that, remember our corn balance sheet is domestic oriented towards ethanol and domestic feed, and our domestic bean is oriented towards exports and the ability for global consumption increases. I want to quickly review a slide for those of you that I had an opportunity to talk to last time saw, and I just want to reiterate, it's the same slide, and that is, what's this algorithmic trading? What is this system trading? What is this frequency trading? What it is here's a short definition of what it is. It's a process of using computer programs to follow a defined set of instructions, those instructions being a defined set of parameters against price asset aspirations or expectations, and placing a trade in order to generate profits at speed and frequency. Okay, so what does that mean? Those system trading things have certain things and they don't have certain things. What are they? They're automated, they're frequency oriented, they don't have any emotions, they don't think like you and I, okay? They move basis deviations to what the defined parameters are. They're oriented toward asset valuation. Majority of the time, they're trend following. They're not price predictive. They're not predicting prices. They're following trends once there's a trend reversal. They're almost always speculative in nature, and they have a high risk tolerance, okay? So why is that important? Why is this systems trading approach important? It's important as we look at these supply and demand and production orientation, because the managed money, a critical aspect of the zero net sum game in futures and options, managed capital is the biggest and most important player in the non-commercial speculative sector, okay? And they're the flip side of commercialism and the producer merchants, okay? So it's very important what they do with their private capital, how they trade it, and what they're looking at in terms of those algorithmic or systemic trading systems. And take a look at this real quick. This is the commitment of traders last week. And you can look at it specifically and say a couple things. One is that the corn's reducing their shorts on the managed money ownership. The wheat is reducing their shorts on a managed money ownership. And the soybeans are net long, pretty nice. And what does that mean? That means that recently the corn ownership on managed money saw being down there at 230,000 short contracts was too risk adverse to their ownership, so they make it moved to get out of that, okay? Wheat, a little bit to the same, to a lesser extent. Soybeans, on the other hand, the managed money has positioned their contractual ownership as nice on the long side, but it provides a nice blue sky way up or a nice basement down, depending on what their risk tolerance tells them on which way to move on ownership. So my point here of this chart is simply you follow the money and you look at where the cash is and why. And the managed money is driving the bus on that. It's not the commercial sector and it's not the producer merchants. It's the managed money, and their systems trading approach had those characteristics we talked about a little bit earlier. So you need to keep that on top of mind. Let's look at a couple of charts just to see where beans are, because remember, they're demand sensitive. They have a demand-driven physical asset balance sheet. And in that, the managed money is going to be looking at a demand orientation in terms of see where they move their money in the soybean portfolios, okay? And this is just a chart that shows our ending stocks. It's not critical one way or another yet, but if our end stocks keep growing as a result of reduced demand, you can see where that's going to place us in a precarious position, potentially back there where we do have stocks that are based on this chart are the second highest of the chart history. Now, the other part of the chart shows what's the stocks usage ratio, and that's not necessarily sensitive at this point either, but can be if we keep driving up stocks as a result of reduced demand. And let's be honest with each other, the demand side of the business in soybeans, the sensitive side of the demand business is not in domestic crush. It's not in domestic crush of meal and oil. It's in exports. Because all of you that are soybean farmers, every fourth row in your field goes to China, okay? So I don't need to sit here and preach to the choir how important that is. It's extremely important. The next slide, I want you to really take a look at and heed, please, what I'm talking about. Interpret it as you see necessary, okay? This is the export curve. This is the export shipment curve from the United States for exports of soybeans, okay? And I want you to take a couple critical things away from here. One is that curve is very steep from October to the end of January, okay? It's like going up a roller coaster at Six Flags. We've got to get up it. We got to get up that steep curve, and we got to get up it fast, and then we stabilize out, and the kids aren't screaming in the roller coaster cart anymore, okay? And why is that important? That's important because if you either get ahead or behind going up that steep October through January curve, then you're going to make up lots of time opportunity lots of time opportunity based on that critical volume period. And you're either going to get way ahead or way behind on your exports if you don't hold one direction or another. So the second important thing to take away is, wait a minute. The orange line shows us this marketing year exports compared to last year's export, which is that green hump, okay? And the 4-year trend line average is the black line. And we are falling behind at the most critical time of bean exports that we need. Once we get into the mid hump of that curve, if we're behind, I think it goes without saying, I mean, it's going to be a push to get back caught up. So there's a couple of things you need to be concerned about on this chart. One is, number one, we're behind a year ago. And two is that we're getting behind in the most critical time of the year. So, my only point is the USDA increased their soybean exports last report, and now they've taken it back off. So this might be something trendy that puts some critical analysis and sensitivity back into the balance sheets. Let's look at a couple of charts. I'm not going to dwell on charts so long. I just want to give you a snapshot of what the charts are after yesterday's supply and demand and production report, okay? And by the way, I didn't mention this earlier, but production didn't change at all in any of the three key grain groups. So we're talking about fundamentals now, fundamental supply and demand. Let's take a quick look at July corn. I want to point out a couple of things here. One is that the corn is in a tight range, okay? You can see what that range is. This is July corn. The price channel is 381 down to a 364 approximately, okay? And in that, I've placed two exponential moving averages, the red and the blue line on the candlesticks, and that's what drives the MACD oscillator below. Now, the reason I show the oscillator below and the two arrows are that when we hit the low back in August on July corn, and then we broke through that low last week, what were the oscillators telling us? And the oscillators are very important because they're what the managed money uses in their trading system. Now, they may use the MACD, they may use other oscillators, but the point is we're in a very critical, what's called divergence infrastructure. And that means that whatever the oscillators were doing when we had our low in July, those oscillators are much different right now. And they're showing us that the oscillators have less strength, less intensivity. Even though we're in a trend, that trend is much weaker than it was in August, okay? And that is called a divergence, a bullish divergence, which means, hey, maybe our low's already come in, maybe it hasn't. But if it hasn't and we hit another low, what's the oscillator going to be as compared? So what the divergence says is the oscillator was much stronger. It had much more intensivity. It was moving much faster in August when we hit our low than when we hit our recent low here. So that's what tells us. And that's a key trading platform with the managed money and the speculative systemic trading system. So that's your competition. Now let's take a look at soybeans. What does soybeans tell us? Soybeans tells us a different story. We're also in a channel just like we are in corn. You can see the channel. We've got the regression lines there, the mid and top and bottom regression lines on the standard deviation. And it says right now July beans are in a 1040 to 1003 or 1004 range. Okay. Now what does that tell us? That tells us that we're not in a divergent mode, because if you go back and look at the June low and then the July low, okay, we weren't in a divergent mode because the oscillators were different. What it does tell us, and I bracketed there for you up on the chart and down below on the oscillator, is that basically we're in a neutralized oscillation or systemic trading approach, and that is reinforced by us being in that price channel. That's what it tells us right now. So let's take a look now. Given that we talked about the sensitivity of the balance sheets, we talked about the sensitivity of the demand versus the supply on the corn and bean balance sheets. We talked about the physical balance sheets and how supply can be maneuvered via reduction of supply or increased demand. And we took a look at the balance sheet. We talked about the criticality of the global demand or the end stocks, and the criticality of Chinese imports of beans. And then we briefly talked about a couple of things that were sensitive in terms of potential demand infrastructure dynamics for beans. We did that with the carryover, and then we looked at the exports. So where does that put us? These are some general takeaways that I would recommend you take under consideration. And I say that because I'm speaking to what I believe mostly a commercial audience, your producers. Okay, so what does this all mean to you? There's a lot of focus right now on La Nina, and I wouldn't build too much wishful thinking in La Nina. I will throw a bone out here and say, right now the focus of La Nina is on Argentina dry weather, and that's going to impact global soybean meal. End of story, okay? What about the weather here? Well, La Nina right now in South America, beyond the Argentinian soybean meal aspects, probably doesn't look very strong to drive either a supply and or demand opportunity that perhaps maybe might mirror what we got last year, okay? However, the markets are closely watching how weather in La Nina will potentially impact what we have in the United States, and that's going to be critical to our corn crop next year. So I put a question mark there. The domestic corn and wheat balance sheets are going to be totally oriented as we move through this marketing year, and we're the first quarter done here soon, and we're going to move into the second quarter, potentially where some cycle lows might come in. Those balance sheets are going to be oriented towards end game inventories, okay, end game stockpiles, and if we can hold supply on the front end side to not increase those stockpiles. That's going to be the game moving forward. Bean balance sheets on the other side is going to be towards export demand, okay? And we need to look at what the domestic corn demand enhancements might be. Are we going to be able to sustain some of that strength of ethanol to take some bites out of the end game balance sheet? And are we going to be able to catch up on the flip side on the demand of beans? Are we going to be able to keep up with that export demand and catch up to that curve we need to get? So that's where we are. I would challenge all of you, if you're clients of ours or a subscriber of David's, to take a look at our continued recommendations to either put some floors on your corn and beans and wheat, or repaper, either with options or futures, out into July, and then look at the next cycle of taking this thing out into November and December next year as needed in terms of what your business units are telling you and what your risk tolerance is. So that's all I have. Honored to talk to you today. I hope this was useful to those of you that are watching it. And with that, I shall wish all of you and yours a Merry Christmas here as we're moving into that season very quickly. And please, a safe remainder of the week and a very safe holiday period for you and your extended family. So God bless you all, and thank you for your time and your consideration. Okay, bye all to you. Merry Christmas.